Welcome everyone to today's lecture. We stopped here at point 6.3 in our outline right before the discussion of the different risk types. And here I want to show you and discuss with you some basic elementary risk types that can be found in almost all industrial firms, but particularly, of course, in financial institutions and in banks. We only look at financial risks here. And there are a couple of reasons why we concentrate on financial risks. The main reason is that financial risks are A, very important to the very existence of the firm, and B, they can be managed. We will not look, and usually in risk management no one does that, we will not look at the general business risk of a company. Meaning that, for example, the perfume store has the risk that if they do not offer the right products, they will go out of business. That's the general business risk, and that's the risk every entrepreneur will have to take in order to be successful as a businessman or businesswoman. Here, however, we are dealing with financial risks that arise from the financial realm of the company, and these can be managed. And the firm can do something about these financial risks, and banks also face most of these risks. So we'll be dealing with financial risks. Those can be defined as those risks that originate in the investment and financing activities of a company, and thus in the firm's interaction with financial markets. That's a very general, very broad definition. Usually we'll see that financial risks arise from changes in some kind of market parameter, and most of the cases this will be a market price. It could also be that we still have some payments due, some receivables from our trade business, or maybe because we have granted loans. And if the debtors default on these loans, on our receivables, we'll be facing what we call credit risk. So we'll have market prices, default probabilities that might change, and finally illiquidity that looms over the company if we are not able to fulfill our payment obligations. And these are just three sources and origins of financial risks for a company. Here you can see the 2017 risk report of Deutsche Bank, and over the next couple of slides I will give you a couple of examples taken from the annual statements of banks when it comes to risk reporting. One of the reasons is, well, it's an introduction to banking class, but the other reason is banks and financial institutions in general are forced by regulators and supervisors to report a lot on their risk management activities. It might be that large industrial firms also have such an elaborate risk management, but they do not report about it and they do not disclose any information on that, but banks have to due to regulation. This is why we have a lot of banking examples here. And you can see here from this risk profile of Deutsche Bank that they clearly identify credit risk, market risk, diversification benefit, business risk, and operational risk as the large and most important risk types in their annual statement. There is a reason to this, why they report on three main areas from which risks originate: credit risk, market risk, and operational risk, and we'll talk about this later. But at this point you can already see that it's not a huge list. You do not have 25 different types of risks, but especially for banks, it's usually market price, credit risk, and operational risk, and hopefully some diversification benefit. Is everyone clear on what diversification benefit means in this context? No. Diversification, that's clear. Yeah, it's a simple idea of not putting all your eggs in one basket. For example, if I were to give you €1 million, hopefully you would not invest all of it in just one single stock, but you would try to diversify your investment. And there are some smart and some dumb ways to diversify, but if you already diversify, that's a good start. So diversification means that you invest in different types of assets, with the idea of that if one asset goes up, the price of the other might go down, and the changes in prices will nullify themselves, so that in total you will be better off than just by investing in one asset. And this is a very naive idea of diversification, but that's basically what it entails. And diversification benefit here means that the bank has exposure to some risks, but because these risks have, there are interaction effects between those risks, it might be that even though they have different risks and a total exposure that can be calculated by summing up the risk exposure, there are also some diversification benefits that will reduce their total risk exposure to some extent. You will not be able to fully hedge your risk exposure, but you will have some hopefully significant diversification effect. And here I think it is 7 billion euros, I would guess. Yeah, in million euros here. You need glasses to read this. So they have diversification benefits of almost 7 billion euros. Okay. I will later on explain how they came up with these numbers. And actually, this usually is not risk, but as you can see here, it's what we call economic capital. And I will talk about this later on in more detail, but at this point it suffices to see this as some way of measuring risk and risk exposure. Okay. Now let's start with market price risk, or market risk, simply market risk. Those are those risks that arise as a result of changes in relevant market prices, meaning everything for which we have a market and thus a market price, everything can lead to market risk exposure. And you have to be clear on the fact that something that you wouldn't naturally consider to be a price, economically speaking, is actually a price. What do I mean with that? Interest rates. Interest rates are nothing but the market price for giving someone else a certain amount of capital. You know, if you give out a loan, if you lend money and you earn an interest rate, that's the market price for capital. So market prices here include stock prices, bond prices, interest rates, also commodity prices, the price for orange juice, oil, gas, natural gas, and so on, commodity prices, and also foreign exchange. If you ever see the two words FX, this is just the abbreviation for foreign exchange. And if you ever see something like an FX swap, an FX option, an FX future, you should by now know that this is a derivative on an exchange rate. So an exchange rate is nothing but a market price for foreign currency. And therefore, market price risk includes all those risks that originate and are based on changes in these relevant market prices. Here's another extract from the risk report of Deutsche Bank. Our market risk framework. The vast majority of our businesses are subject to market risk, defined as the potential for change in the market value of our trading and invest positions. Risk can arise from changes in interest rates, credit spreads, foreign exchange rates, equity prices, aka stock prices, commodity prices, and other relevant parameters such as market volatility and market implied default probabilities. I will leave you with this definition. I think it's not very clear cut because it somehow mixes up credit risk and market price risk. However, obviously, credit risk and credit investments by now with modern financial markets, credit risk also includes credit derivatives, traded products that are somehow linked to credit probability and default probabilities. And credit risk does not simply include loans that you can take or give. Credit risk nowadays with modern financial markets, credit investments can be quite sophisticated, and then these products might be traded, and if they are traded, market prices will obviously depend on some kind of default probability. But usually, especially for smaller companies, for industrial companies and for smaller banks, I would guess that default probability should not really impact market risk exposure, because these companies will not trade in this complex financially engineered products. Okay. Actually, this is the same. I don't know why this has been copied. Okay, here. Market risk management governance is designed and established to promote oversight of all market risks, effective decision-making, and timely escalation to senior management. We aim to accurately measure all types of market risk by a comprehensive set of risk metrics embedding accounting, economic, and regulatory considerations. Now, this is a lot of management talk just to pacify regulators, but you get the idea. Okay. So that's the general definition of market risk. Now let's turn to currency risk. This is very simple. Currency risks and international banks are, especially international banks, are exposed to currency risk via then very different transactions. And currency risks are those financial risks of a bank that arise from entering contracts that are written in a foreign currency. For a bank now, I would assume that in many cases, these products are securities, financial products that are traded around the world on global markets, and not so much loans. For a loan to be given out in a foreign currency, I would guess that a company will operate a subsidiary in a different country. For example, Deutsche Bank operates a subsidiary in Japan, and if they want to give out a loan in Japanese yen, they will do it via their Japanese subsidiary and their affiliate office in Japan. However, some other companies might trade in securities on different stock exchanges, on different markets, and even though they don't have an office in this country, they might still trade on that particular exchange. And in these cases might be that they will be dealing in financial products and contracts that are written in a foreign currency. The same applies especially to industrial companies. Imagine you look at BMW or Daimler. They will buy steel, they will buy aluminum, they will buy different types of resources. And in many cases, these resources and raw materials will be imported from foreign countries, and then they will sell their products, their cars, also to foreign countries. And then you have risk exposure to currency risks. Very simple example. You have a car manufacturer, you produce your cars in Germany and you sell them in Japan. Then your costs in euros will be offset by revenues in Japanese yen. And if the currency changes, you might be better or worse off afterwards, simply by a difference in the exchange rate. If the exchange rate changes, automobile manufacturer will receive higher or lower sales revenues for its products sold in Japan. Now, what can you do to hedge this risk? I go into more detail in the financial risk management class next semester, but a very simple way of dealing with currency risk is to do what? And every industrial company usually does this. You try, if you know that you have a large exposure to currency risk, and this might completely destroy all your chances of generating a profit, what do you do? Yeah?
Maybe invest on future contracts.
You can. That's very sophisticated. You can do financial hedging. You can use financial derivatives like a future on the exchange rate to hedge your exposure. That's one possibility. But if you think of car manufacturers, what do they usually do? Because there are also other reasons to do this. Like BMW, you will open up a production plant in the US. You will, if you are Toyota, you will open up a production plant in Europe. You will not export your products, but you will open up a production plant in the country in which you are trying to sell your products. For cars, there are also other reasons to do this. For example, you might know that the American, Japanese, and European customers have different ideas of how a car should look like. And then in order of producing a European car and selling it off to the US, a better way, also due to currency risk and taxation, a better way to do this is just to move a production plant to this country if the market is large enough. That is why, for example, BMW and other companies operate production plants in the United States and do not simply export products from Europe to the US. And tariffs are also an important reason for this. Securities risk. Now, that's quite obvious. If you trade in securities, if you buy or sell a stock, if the market price, if the stock price changes, you will have a security risk, you will have a market price risk. Simply remember, just remember that securities can also mean bonds. And then you have a bond investment, and the bond price can obviously also change. The difference is that usually bonds are not as liquid as stocks for many companies, and bond prices will also, well, it's a tricky question with bond prices. Is everyone clear what a bond is and how the price of a bond can be derived? Everyone clear? Yeah? A bond investment is pretty much like a loan that can be traded. So if I give out a loan in the form of a bond, of a corporate bond, what does the bond price reflect? The probability of the initial notional amount, let's say $100, the probability that the notional amount, the notional investment sum, is repaid with full interest. And this probability is obviously causally related to the default probability of the issuing company. So yes, you can say it's a market price and the price can go up and can go down, but these changes in market prices will also reflect changes in market interest rates and in the default probability of the issuing company. No? For stocks, it's the same. I mean, the stock price will reflect profits and future growth outlook for a company. Okay. And you will try to forecast prices, and you will have a look at market price volatility. And then this is where financial econometrics and quantitative risk management will start, and you will need sophisticated models to forecast your stock volatility and stock prices. Okay. Interest rate risks, also very clear. Every time you have a fixed payment and a fixed interest product, the value of this fixed income product will somehow be related to interest rates. And interest rate risk is defined and comprises losses on assets resulting from changes in the market interest rate that is relevant for an asset position. So very simple, and there are actually two ways to look at this. First of all, imagine that, and actually I did that last week, imagine you want to give out a loan. And nowadays with peer-to-peer lending platforms and crowdfunding platforms, it's quite easy for you to do this as a private person. Imagine you want to give out a loan of 100 euros. I select a couple of you and you get a loan. We will agree on an interest rate, and I would say I want an interest rate of, say, 4%. Now there are two possibilities and two sources of risk for this position. First of all, you have opportunity risk and opportunity costs. Why? Imagine market interest rates will increase to, let's say, 10%. First of all, I have opportunity costs, because now I look quite stupid with my 4% if suddenly the risk-free rate on the market is 10% in contrast to 0% right now. So I have opportunity costs that I could have given out my loan at a much higher interest rate. But that obviously is just opportunity. These are opportunity costs for me and not real financial losses. However, if I keep this loan till the very end, I get my 4%. Okay, I'm done. But imagine now I could trade on this loan. I could sell this loan just like a security, like a bond, and I could sell it to another market participant. What would happen is that how would you calculate the fair price of such a bond, of such a loan? You would take the future cash flows and discount them by using the relevant interest rate. And the relevant risk-adjusted interest rate will be risk-free rate plus a risk premium. If now the risk-free rate increases to 10%, I would assume the relevant discount rate would be 12, 14, 15%. I have future payments. The discount rate increases dramatically. I will discount all my future payments, and the current net present value of my loan will be lower. Meaning the current market price of my loan will heavily decrease because market interest rates have risen. And this is a direct cost to me if I want to resell it. If I want to sell my loan, if I want to sell my bond. So you will have two sources of potential risk of a potential financial loss in case you have an interest-bearing security, and that can be a traded security, but it can also simply be a loan that you've given out, in the form of opportunity costs and decreases in market prices for traded securities. Also, remember that every time you hear the words fixed income, it means more or less loans and bonds, especially bonds and other related financial products that guarantee fixed payments. That's fixed income, sometimes fixed interest, but usually it's fixed income. There is also an academic journal that concentrates on these types of bond securities, the Journal of Fixed Income. And do not mix it up with FX. FX is foreign exchange. One might think of foreign fixed also includes an X, fixed income, but FX is foreign exchange. Interest rate risks. Two examples. I think I've described these examples to you. First of all, you have a loan. Might be that the resale value of the loan decreases. Also, if obviously market interest rate changes in interest-bearing securities, you will have direct price losses and decreases in prices. Okay. Then, next scenario, you have what we call a floating rate agreement or a floater. You can obviously buy not just fixed income products, but you can also buy bonds and bond-like securities that pay out a variable interest rate. And if the interest rate is variable, we speak of a floating rate note or floating rate agreement, and those are just how do you say that in English? Those are just the variants of a fixed income bond that pay out a variable interest rate. And these interest rates are almost always fixed to an interbank offered rate, like the Euribor or some other type of market interest rate. And obviously, if these market rates, interest rates change, your variable interest payments will also decrease or increase. And the question then is, does the price for these interest floating rate notes change? Well, not really, because the payments in the future change, but also the discount factors that are relevant for coming up with the price, they will also change. So market prices for these floating rate agreements are actually a little bit less sensitive to changes in market risks, market interest rates. Just imagine it like this. You have a coupon bond and you would calculate the fair price in a very simplistic model like this. And this is a fixed income product. If market interest rates change, the discount factors will change. But if you have a floating rate note, this will look something like this, and you will see that not only do the discount factors change, but also the payments will change into the other direction. So you, for example, you will have higher payments in the future, but the discount factors will also be higher, leading to a lower net present value today. And this is why this type of instrument will have a lower sensitivity to changes in market interest rates, in contrast to a fixed income product. Okay, and then we have credit risk. Credit risk is quite simple. If you have a loan outstanding, if you have given out money to someone, or if you are still expecting a payment from someone, you will have a credit risk. If he or she doesn't pay up, you might lose your investment, and this is credit risk. Sometimes it's called default risk, and in some instances it's also referred to as counterparty risk, but we'll see a little bit more about this later on. No? But it is important to note that even though credit risk is obviously the most important type of risk for banks, everyone, almost every company that delivers its services and products before payment, each and every one of these companies faces credit risk. I always give this example of local energy and utility companies in Germany as a good example to see how credit risk can affect even small companies. Imagine if you are living here in Leipzig, it's most likely that you have an energy contract for electricity, maybe even gas and water, with the local municipal utilities company, the Stadtwerke. So, and they also face credit risk, because if you do not pay your bill, electricity is delivered to your household and you will use up electricity. If you default and you do not pay your bill, the utilities and energy company will not be able to recover the electricity that has already been delivered. They cannot squeeze out the electricity from your household or your TV. Then they will have credit risk. And actually they face a lot of credit risk, because in some places, probably in Leipzig, but in some other cities, a lot of households cannot pay their energy bills. Do you know how they limit credit risk? In a very simple way. They will stop delivering and supplying you with electricity after 3 months of no bill having been paid. So if you do not pay your third electricity bill in a row, they will cut you off from their supply, making sure that you will only use up like 3 months of electricity, and they can limit their exposure, say, to maybe 100 euros per month. So 3 months, that's a maximum of 300 euros per household and per customer. You know, it's different than in banking, but even these companies have credit risk. If you go to the shoe store, if you buy some shoes and you take the shoes with you, you wear them for a day, and you do not immediately pay, you can still default on your payment, and then the shop will have a hard time selling your smelling shoes, maybe. Yeah? So almost every company has credit risk exposure. Not just banks, but banks obviously have a lot of it. Okay. Yeah, I think I said all of this already. Loan granting and lending directly leads to credit risk, but industrial firms also have high credit risk exposure. Okay. Now there's a fine distinction we can make between credit risk in the strict sense and credit risk in the broader sense. There's a small typo here. Credit risk in the broader sense. In the strict sense, credit risk means the probability of you defaulting. This is a very simple 1-0 view, dichotomous view. I don't know how to pronounce that in English, dichotom in German. I know how to spell it, but I don't know how to pronounce it. Dichotomous. The idea is that there are only two possibilities. You can either default or you don't. That's credit risk in the strict sense. Credit risk in the broader sense is that you have a probability of default, and you might have 100% risk-free. You might have a default probability of 2%, 5%, 20%, and so on. And this means that in some cases, you're not interested in this difference between default or no default, but you're interested in the likelihood of your customer or your business partner defaulting on you. And if you see a change in the default probability, this is what constitutes credit risk. And this is what you will look at, especially when dealing with large companies. You will not base your models in credit risk management on the default probability of Daimler or BMW, but you will base it on slight and small changes in the default probability of BMW, for example. And this is what often is reflected in the credit rating of a company, and sometimes even of households. And we also have counterparty risk. Counterparty risk is the risk if you enter a contract that your business partner, your counterparty in this contract, is not able to fulfill its end of the business, of the contract. Meaning that counterparty risk can arise in areas where you didn't expect credit risk. A famous example is counterparty risk in credit default swaps. What is a credit default swap? A credit default swap is a credit derivative that is traded OTC. It's not really a financial security, but it's a financial contract two business partners, two usually large companies agree on. And what do they do? Let's assume we have BMW here and Deutsche Bank. Deutsche Bank gives a loan 1 billion euros to BMW. They get, it doesn't matter how much interest they get, but they have given out a loan of 1 billion euros to BMW. Now Deutsche Bank realizes for some reason that this risk exposure is too high. They want to get out. Now they cannot simply get out of the loan contract, but they want to decrease their risk exposure. They want to limit credit risk. What they can do is now, obviously BMW has to pay interest rate, let's say just percent. They will look for a financial investor, and let's assume this is Goldman Sachs, and they will agree on a contract, on a so-called CDS, a credit default swap, that looks like this. Deutsche Bank pays, let's say, 3% interest rate on 200 million euros as a fee, and Goldman Sachs will pay 200 millions only in case BMW defaults. And this is a credit default swap. Credit risk is swapped between the two partners here, and Deutsche Bank now has more or less default insurance with a notional amount of 200 million, and the 200 million euros are only paid out to Deutsche Bank in case BMW defaults. As you can see, it's a credit derivative. Why? It's a contract whose value is derived from the credit probability of BMW. It's not really a security. It's an OTC traded financial contract. And you have seen this even in Hollywood. If you've seen the movie The Big Short, this is what Christian Bale does with, I think, Merrill Lynch. He goes to Merrill Lynch, talks to a bunch of investment bankers and says, I have these mortgage loan portfolios. I want to buy a credit default swap with these as the reference entity. And they will say, we can offer you credit default swap with a notional amount of, say, 50 million, 100 million at a price of 3% per quarter or whatever. And he says, oh, I want even more. And then they would say, okay, let's make it 300 million. You know? And you have credit default swap and insurance against the default of BMW. Now, this is a very nice thing. Problem is that what happens if Goldman Sachs defaults? As in the movie and as in reality during the financial crisis, this is an OTC traded financial contract. It's a contract between you, Deutsche Bank, and Goldman Sachs. If Goldman Sachs defaults, the contract is void. Yeah, you can try to get some money out of bankrupt Goldman Sachs, but this will not work and you will have no insurance. Is this a problem for you? Yes and no. First of all, it's no problem. Why? Because you do not have to pay anything. The contract will run out and you will not be required to pay anything to Goldman Sachs if Goldman Sachs defaults. But what happens if BMW now defaults? Deutsche Bank thought it had credit insurance for the case of BMW defaulting. BMW defaults. They thought, Deutsche Bank now thinks, okay, we can recover 30% from our credit default swap from Goldman Sachs. And Goldman Sachs is no longer with us, and this is counterparty risk. The counterparty in your contract cannot and can no longer fulfill his obligations from this contract. And this is exactly the scenario that happened during the financial crisis. Most banks bought CDS contracts, and as most of them found out later on, in this case, everyone had bought a credit default swap with one single entity as the counterparty. Everyone thought we have credit insurance and default insurance, and at some point everyone in the market realized that they had bought credit default swaps from just one market participant, and that was AIG, or a subsidiary of AIG. And AIG faced bankruptcy, and AIG had to be bailed out as the very first large insurance company in the world that was bailed out during a crisis. It was not because of their insurance business, but because they had started to become a trading company, more or less. This is counterparty risk. Some other varieties of counterparty risk. Replacement risk from derivatives, we've just seen this. Issuer risk, performance risk, country risk, also sovereign risk. Those are just some variants of counterparty risk, and this has become very important since the financial crisis. One way to deal with this is to include a central counterparty. As you've seen, this type of contract is OTC traded. What does OTC mean? Can anyone explain the difference between an exchange traded product and an OTC traded product? OTC stands for, probably on the, it's on the slide, over the counter. What's the difference between an exchange traded security and an OTC traded security? Any idea? Yeah? Try.
I think that the OTC securities are not included in the balance sheet of the institution.
No. The fundamental difference is, if I go to the Frankfurt Stock Exchange, and if I want to buy a stock, the stock exchange will first check all market participants, if they are qualified, if they have paid their margin requirements, if they have a trading account, and then if I want to buy a stock, I will not know from whom I can buy this stock. I will only see prices in the trading system, etc. And then I will place an order. The stock exchange will match orders. And if the stock exchange says, yes, congratulations, you are able, we have successfully matched your order against a sell order, then the stock exchange will guarantee clearing and settlement of the trade. And I will not know from whom I've bought the stock. I will buy it, I will pay the money into my account with the German Stock Exchange. And it might be that, for example, you were the seller of the stock, and you will have to give the stock to the stock exchange. The stock exchange will give me the stock, and I will pay the money, and it will transfer the money to you, minus the fees, etc. But if you do not deliver the stock, I will still get the stock, and the stock exchange will guarantee that I will be able to get my stock. If you do not give the stock to the stock exchange, they will kick you out, and they will make sure that you suffer. Otherwise, if you give the stock to the stock exchange and I cannot pay, they will kick me out, and they will make sure that I pay up. That's one of the fundamental functions of a stock exchange or any securities exchange. They will guarantee, first of all, of course, the market making, and they will guarantee the trading. They will match orders, but they will also guarantee clearing and settlement of those trades, because they want market participants to trust that if they engage in trading, those trades will be executed. The difference in an OTC market is there might be a platform, there might be a trading system, but I will enter a trade or an order just like on probably, I don't know, Craigslist or eBay. Someone else will see this, and they will come to me and they will say, okay, let's engage in negotiations. The exchange and the platform will only supply you with the information who is entering orders, and you can see those orders, but they will not guarantee the price, they will not guarantee settlement, and they will not guarantee clearing. And in institutional trading, obviously, you know who the big market participants are. And again, if you want to see this in almost real life, just watch it in Hollywood movies. Yeah, an investment banker will pick up the phone, will call his contacts at another investment bank or a trading company, and they will ask for a specific contract. And I need, for example, a default swap contract written on Deutsche Bank, 50 million euros notional. What price can you offer me? They will say, we can sell it to you for 6% annually, and then the middle and back office will come up with the contract. Someone will sign the contract, and this is the OTC contract. And here you can see why OTC trading can be dangerous, because no one guarantees that these contracts will be fulfilled. You have counterparty risk. And one way to deal with this counterparty risk is to include a central counterparty who then guarantees clearing again. And then you come a little bit closer into this scenario where you have an exchange and the securities are traded on an exchange. And this is one of the takeaways from the financial crisis, that some OTC markets were not very transparent and you need a central counterparty for this. By the way, what is clearing? Clearing is the entire process of settling a financial transaction. This includes determination and settlement of mutual claims, liabilities, delivery obligations, as well as the transmission and reconciliation of information relevant for processing. And this is done on an exchange, for example. Here you have an extract from the Wall Street Journal. US to take over AIG in 85 billion bailout. Central banks inject cash as credit dries up. And this is a very important turning point in the regulation of insurance companies worldwide, because this was a huge disaster for regulators and supervisors, and the very first case where a large insurance company became systemically relevant. And there are two different views on this. The first view, shared especially after the financial crisis, shared by many insurance economists, especially in the US, was, let's not over-exaggerate. AIG, yes, it was is an insurance company, but the systemic relevance didn't came from the insurance sector. It came from the banking activities and the trading activities of a company that coincidentally was also the largest insurance company of the world at that time. Some other people say, and regulators have taken up this view, that yes, insurance companies can become systemically relevant as soon as they start to engage in non-insurance and non-traditional activities. Insurance companies are usually also very big in size, large in size, and they have huge and can have huge impact on the economy if something goes wrong in an insurance company. And this is described here by the Wall Street Journal. For one thing, banks and mutual funds are major holders of AIG's debt and could take a hit if the insurer were to default. In addition, AIG was a major seller of credit default swaps, essentially insurance against default on assets tied to corporate debt and mortgage securities. AIG's millions of insurance policyholders appear to be considerably less at risk. Well, it wasn't the insurance business that got AIG into trouble. Okay. Here, another extract from the management report of the DZ Bank. The DZ Bank is, if you might remember, the top-level institute of the German credit unions. It's a very large bank located in Frankfurt, and you can see that they also report on their credit risk exposure stemming from loans given out, for example, in the financial sector, to the public sector, to corporates, to retail investors, industry conglomerates, and they had a credit risk exposure measured by the lending volume of 280 billion euros. And this is what they show as their credit risk exposure. Now, up to this point, we've only talked about financial risk that can lead to losses, but in the very end, you do not go bankrupt because you suffer a loss. Every day you experience profits and losses, and only at some point might these losses pile up to such an extent that your very existence as a firm is endangered. And this is closely related to liquidity risk. Now, in most cases, insolvency, bankruptcy, is not triggered by a loss, but it's triggered by the company's inability to be able to meet the company's short-term payment obligations. If you cannot pay your bills, that's liquidity risk. And market price risks and credit risks may lead to losses, but in the end, they only become a threat to the company if you also have liquidity risk. And this is why banks, especially, are also very much concerned about liquidity risk, not just financial risk in the form of credit risk, market price risk. The liquidity of a company, what is that? First of all, you have to be sure to distinguish between two different types of liquidity. We distinguish between the liquidity of an asset and the liquidity of a company. Let's start with the liquidity of an asset. The liquidity of an asset is defined as the ease with which you can buy or sell a given asset. Meaning that this pen here, it would be quite difficult for me to sell this pen. Why? because it's very specific. You can only use it with this type of equipment, and there's not a huge market for this. So this pen is not very liquid. There is no liquid market for these used pens. In contrast, what is by definition the most liquid asset? Yeah? Money, cash, right. Because if I give you 10 euros, hopefully you will only give me exactly 10 euros back in cash. So this is the range from cash to very illiquid assets. And remember, liquidity is the ease with which you can buy or sell an asset. Or even more generally speaking, the ease with which you can enter a contract. Now, remember the credit default swap. We had BMW as the reference unit, and investment bank here, and let's say Deutsche Bank here. They enter a contract. Deutsche Bank is looking for an investor to offer credit default insurance for a certain price. And again, they are not selling anything. Yes, they are selling the service of providing insurance, but let's not say that someone is selling or buying. But assume, well, yeah, actually it is said to be the seller of CDS. But here you can see in this example, it's basically a contract. Yeah? You can even define liquidity for household services. If I need a gardener and I'm looking for someone to do my garden, I could speak of liquidity. How difficult is it to find a gardener that will offer me a certain service and enter a contract with me? If I find a gardener right away, then it's a very liquid service or a very liquid asset. If I need some additional time, if I need to spend money on finding a gardener, then this is a service that is not very liquid. Same here. If I look for someone to offer me default insurance, and this is quite easy, then the CDS market is very liquid. If I need to spend some time to enter such a contract, then the market is not very liquid. And here, also you can see that, especially in this case of a derivative market, liquidity works in two ways. Because I could be interested in buying insurance, and I could be interested in selling insurance. So liquidity can work in different ways for the buyers and sellers of this service, of this insurance. Okay, so that's the liquidity of an asset. Then what is the liquidity of a market? Well, you can obviously look not only at the liquidity of an individual asset, of a single stock, but you can also look at the liquidity of all stocks in general on this market, on average. And that is what we refer to as market liquidity. There is a huge literature on the interrelations between stock liquidity and bond liquidity and market liquidity. And they are related, obviously, to each other. I don't want to go into much detail, but if you're interested in this is, especially since the financial crisis, this has become a very important research field. Liquidity, market liquidity, and bond and stock liquidity. And here, we then also have liquidity, the liquidity of a company. What is the liquidity of a company? A company is liquid if it is able to repay all due payment obligations, if it can pay its bills. And in order to pay the bills, you need cash, cash equivalents, or assets that can easily be liquidated. If you do not have liquidity, and if you only have assets that are illiquid, it is highly likely that you cannot pay your bills, and then you will go get bankrupt. So asset liquidity is linked to market liquidity, and asset liquidity is also linked to a company's liquidity, because the company holds assets that are more or less liquid. And if you cannot pay your bills, you will have to file for bankruptcy. And if you delay this, you might be liable, and you might be persecuted under penal law. And in German, this is Insolvenzverschleppung, ein Straftatbestand, können wir verklagt werden, strafrechtlich. And I guess in every modern country you will have some penal statutes that will give out fines and even jail sentences if you delay filing for bankruptcy, because this amounts to investor fraud, because you're defrauding investors. Now, what is liquidity risk? Liquidity risk is the risk that a company has insufficient liquid funds to settle all short-term liabilities. It can arise in the company in two ways. First of all, you suddenly have less liquidity, or you suddenly have more obligations. Those are the two ways how liquidity risk can arise. And expiring loans may not be extended or replaced by new loans, and the liquidity risk of a company is therefore often referred to as refinancing risk. Does anyone know which department in a company is concerned with the liquidity risk and deals with this, especially in large companies? There is usually in larger companies you have a special branch and a special department that looks at liquidity risk and making the best of liquidity. Any idea? No? That's usually the treasury of a company. If you ever see a job description like head of treasury, means that this is the department in which you try to invest surplus and excess liquidity, but also the department that is responsible for making sure that you always have the necessary liquidity in your company to pay your bills. In smaller firms you will not see this, but every large company usually has a treasury department. Okay. Liquidity risk is obviously of particular importance for banks. Why? Banks deal in money and deal in capital. They give out loans. They have huge amounts of cash coming in and going out at the same time. And also, they have maturity transformation as one of their major functions, meaning that they transform short-term capital into long-term investments. And they always have a maturity mismatch on their balance sheet that is not favorable to them. And this means that if, for example, you as bank customers go to your bank and reclaim your investments, your deposits, that is what we call a bank run, then the bank will immediately be bankrupt, because all its money, all its liquidity is tied up in long-term illiquid assets, aka loans. And this is the usual and very famous risk of a bank run due to a maturity mismatch in banking. Now, bank runs represent a central research field in banking and financial intermediation. This is one thing that immediately follows, for example, in the diamond model. We've looked at the diamond model of banking, and I would say the diamond model is the most famous model in banking and financial intermediation, and the second most famous model is the Diamond-Dybvig model of bank runs. And it explains, there's also a model by Gary Gordon from, I think, Yale, and these models try to explain how bank runs can happen, how they can be explained, and what can do against bank runs. Usually it involves deposit insurance. By the way, liquidity risk is not so important for insurance companies. Why? Assume you have a property and casualty, a P&C insurer. In German, Sachversicherer. If you have a P&C property and casualty insurer, they will insure cars, for example. And they will receive premium payments every year or every month. They will have steady incoming cash flows, and they will only pay out cash in case of accidents. And accidents cannot suddenly cluster like panicky people running to a bank and trying to get the deposits. And this is what one would consider to be an insurance run. People running to an insurance company and doing what? They will not all try to get claims. They can only run to their insurance company and cancel their policies. But even that is highly unlikely, and that has never really happened in insurance. There are some few examples of so-called insurance runs in Australia in the last decades, but those were different scenarios. I think there was one insurance run in Australia where policyholders ran to the insurance company because they feared that the insurance company could go bankrupt, and they canceled their policies. However, that was no big problem because all the customers immediately went to other companies, and this particular insurance company only went bankrupt or closed in on bankruptcy because they were trying to more or less corner the market, and offered dumping prices and dumping premiums. And actually all the competitors, they celebrated after that because they were able to force out an unfair competitor from their market. But usually insurance runs do not happen, and they do not have systemic relevance. Yeah.
What would happen in situations, for example, property insurance, natural disasters?
That is a risk, that an insurance company would take a serious blow from a cluster risk, like, for example, a natural catastrophe like a storm or something like that, or a flood. But in these cases, they have reinsurance. Yeah, they will have reinsurance against that. Then it's a risk for the reinsurance company. And one would have to... you would have to make a very complicated case for this system to entirely fail. You would have a reinsurance company defaulting, causing the primary insurer to have no reinsurance, then being hit by the natural disaster, and I would guess that regulators have a close look, or look quite closely on the way they do reinsurance and buy reinsurance and what the reinsurance companies do.
So that's not classified as an insurance run?
No, because actually this is the business model of a reinsurance company, to reimburse primary insurers if they all take a serious hit by a natural disaster. So that would actually, that would be the scenario for which reinsurance company will be prepared. This will go into the profits of the reinsurance company, yes, but it should not surprise them to the extent that they go bankrupt. Another problem is, however, what I would say that there is a slight danger, of course, because nowadays we do not have too many market players in the market for reinsurance. You will have Munich Re, you will have Swiss Re, you will have General Reinsurance, Gen Re, and some other smaller companies. But most of the market is divided up by the large three, Gen Re, especially Munich Re, Swiss Re, Gen Re. Now, if I wouldn't think that they are stupid enough to sell reinsurance that endangers their company as a whole. But then, if they see that the risk exposure is too high even for them, then I would guess the primary insurer, the P&C insurer, they will not be able to buy reinsurance. And then I would hope that regulators will step in and tell the insurance company, the P&C insurer, if you do not have reinsurance, you will need such high capital to set against your risk that the primary insurer will probably think twice about selling insurance in the first place if they see they have a cluster risk. This is the ideal situation where I think regulators do their job, reinsurance company don't go berserk and sell reinsurance that will endanger them, and the primary insurer sticks to their capital requirements. No? Okay. Last type of risk I want to discuss here is operational risk. We've talked about market risk, credit risk, liquidity risk. Operational risk is different for two reasons. First of all, so far, exogenous events, market prices, default probabilities changed, and exogenous events led to a potential financial loss of the bank or of the company. And all of these risks were concerned and were related to the core business of these companies. A bank gives out loans, then you have credit risk. If you buy a security, if you buy a bond, you have market price risk. And if interest rate change, also this is concerned with the core business of the bank. However, there are also some risks that are not concerned with the core business of a bank, and it might be an endogenous source. That it's not just an exogenous risk, but it's an endogenous source. What could they be? Own personnel, own employees, internal processes, own IT systems, etc., own production plants. And then the source of the risk is not outside the company, but it's inside. And this is why we refer to it as endogenous risk. On a very interesting, even more philosophical level, endogenous risk is even more slightly different from the definition I've given here. Endogenous risk can also be understood as a risk that comes in the form of a self-fulfilling prophecy, and that is self-accelerating and self-amplifying. And if you are interested in this, you should read the works by Jon Danielsson from the London School of Economics. He's done some papers on endogenous risk. He has a perfect example for endogenous risk. I guess you are all aware of the Millennium Bridge in London. It was a pedestrian bridge over the River Thames that was open for the millennium. And it is, how should I put it? It's not completely fixed. There is some movement. And if it's very windy, it's not dangerous, of course, but you can feel some slight movement in the bridge. When the bridge was opened, the architects had already anticipated that people will move in different directions. And if a lot of people walk across this bridge, there will be a lot of movement and a lot of energy being transmitted from the people via their feet and their weight onto the bridge. And then if it gets windy, that this bridge should be resistant to wind plus the movements by people. What they didn't anticipate is that if it gets windy, people will feel the movement of the bridge, and their movements will no longer be random, but they will try to act against the movement. And they suddenly will, just like in instant choreography, their movements will be aligned to some extent, and these movements will now no longer be random, but these movements amplified the movements of the bridge that was caused by the wind. And there are some videos you can still see. In the first days the bridge was open, the bridge was extremely dangerous. And they had to rethink the construction of the Millennium Bridge. And this is pure endogenous risk. That actually the risk is not caused by something coming from the outside, but it's actually caused by your actions against what you perceive to be the risk. This is why it's endogenous. And this is very interesting, and you can read more on this from Jon Danielsson. But we'll not go into much detail here when it comes to endogenous risk. We'll simply say that endogenous sources of risk are those sources of risk that lie within a company. Its own personnel, its own systems and processes. Now, in the first case, an exogenous event that is not related to the core business of a company, it might be that you suffer an unexpected major loss because you are being hit by something where you're not looking. For example, a bank can suffer a major hit if its IT systems fail. You are concerned and you know about market prices, you know about credit risk, you know about interest rates, but this doesn't help you if your computers go out, if your employees don't have electricity in their offices. So that might be a problem. Also, we have operational risk here in this very room. It might be that the university burns down, and my favorite example is this beamer hanging from the ceiling. If it falls down and hits someone from you, this is an operational risk for the university, because you might be able to sue the university if this is a hazard, if it's dangerous, and if no proper precautions have been taken. And it's the very same in every company. Fire risk, the risk of flooding, IT risk, the risk that some process fails. This is operational risk. Another example, exogenous event. I once heard from employees of an insurance company in Münster, a medium-sized town in North Rhine-Westphalia. They have identified as an operational risk a chemical plant accident in a chemical plant that is 2-3 kilometers away from the insurance headquarters. Why? Because they say that this chemical plant produces paint. And paint-producing chemical plants are notoriously known for, if something goes wrong, they usually have a poisonous cloud coming out of this plant. And if such a cloud would be blown into the direction of the insurance company's headquarters, they would need to evacuate immediately. But then what would happen? People need to be evacuated, and if all and everyone has been evacuated, you need to keep up operations. You need offices for your people. You cannot simply say, oh, I have 500 employees, you're all on shutdown for a month, but you will have to find offices for them. You will need emergency plans in place that maybe some employees can work from home. And you will need to make sure that your IT systems keep on running, even though the headquarters might not be accessible to humans at that time. So this insurance company has an emergency plan in place for this operational risk that is entirely caused by a completely different company. They have no impact on this chemical plant, but they have an emergency plan in place in case something happens. And this is operational risk. And this changed in 2006, 2007. Before that, regulators were only concerned about credit risk and market risk, full stop. In 2007, with the Basel II regulation for banking, regulators suddenly started to force banks to look at 3 types of risk: market, credit, operational risk. And this is why you can still see this very clear distinction in the risk reports of European banks. Operational risk, credit risk, market price risk. And in many cases, these are the 3 major and main important types of risk. And as I said, this was implemented in Basel II. It has also been introduced into German law. For example, the Solvency Regulation, Solvabilitätsverordnung für Banken. Paragraph 269, section 1 of the German Solvency Regulation. It includes a obviously German definition, but here's a translation of operational risk. Operational risk is the possibility of losses arising from inadequate or failing internal procedures and systems, people, or from external events. This definition also includes legal risk. This definition was adopted from the Basel II regulation, but this is also a paragraph in the German solvency regulation and solvency order. Okay, so as you can see, when regulators started to think about operational risk, they could have also started operational risk is everything that is not credit and market risk. It seems to be the residual bin for credit and market risk. Everything that is not credit or market risk. But here they also positively define what operational risk is. It is failure or inadequate procedures, systems, people, or external events, whatever that may be. It can be a fire, it can be a flood, it can be a chemical plant explosion, everything that has an impact from outside and that can be considered an external event. And also legal risks. That, however, is up to discussion. Personally, I'm not so sure whether legal risk should be considered to be operational risk, to be included in operational risk. But that's an even philosophical question. Careful. Now, for Solvency II, the almost equivalent regulation in insurance, and insurance lags 10 years behind banking here. Solvency II specifies this in the discussion paper Operationale Risiken unter Solvency II aus Sicht der deutschen Versicherungswirtschaft und Versicherungsaufsicht as following. In German, reputational risk arising from strategic decisions and risks actively assumed in connection with insurance products are not covered by operational risk. Reputational risk. That is also something that is quite interesting. I think it makes sense to exclude reputational risk because this is something that follows some other risks. You have an operational risk, and if you also have a reputation loss or reputational loss, that's a different type of risk, and you cannot really do much against, or you should try to eliminate or hedge the first risk and the original risk, and then care about reputational risk. Okay. Most important difference to earlier concept is, as I told you, that it's no longer just defined via what is operational risk. It's not credit or market risk, but you have a positive definition of what operational risk should be. General business risk, reputational risk, and legal risks, depending on the definition you look at, do not count as operational risks. And how are these risks characterized? By high level of loss, very low likelihood, and thus they are very hard to measure. At this point, I give you a small example of Barings Bank, and this is very interesting. I'll talk about this example in just a bit. But these features of operational risk have led to the fact that operational risks are actually usually dealt with by methods from P&C and more general with measures and methods from non-life insurance mathematics. As you can see, the features of operational risks resemble those features of risk that you would buy insurance for. You have a fire risk, you buy a fire insurance. You have a flood risk, you buy flood insurance. You have the risk that a beamer will fall off the ceiling, then you will buy insurance against being sued for that. You will have insurance against that. If you have the risk that a chemical plant explodes in the vicinity of your headquarters, you will buy insurance against that. There's a special word. How do you call an insurance for that? It's Betriebsunterbrechungsversicherung in German. It's insurance against a discontinuation of operations. No, that's basically what happens. You're no longer able to continue your operations. And for example, hopefully every restaurant owner has such an insurance. If, for example, a restaurant has a flood or has some other problem in the kitchen, they will hopefully have insurance against closing down, against the losses they incur from having to close down their restaurant for, say, a month. In German, that's Betriebsunterbrechungsversicherung. But if you see that operational risks are usually the risk you would buy insurance for, this also means that if you are a large company and you want to deal with operational risk, you will use methods from non-life insurance mathematics, Schadenversicherungsmathematik. And all those risks are more or less operational risks. Very rare, and if something happens, it's quite costly. Okay. A very good example of the interaction of all these risks leading ultimately to an operational risk is the fall of Barings Bank. I bring this example in all my lectures, and I'm afraid this is the example that shows me how old I've become, because no one remembers Barings Bank. Barings Bank went bankrupt in the mid-90s. What happened? Barings Bank had a trader called Nick Leeson. Not Liam Neeson, but Nick Leeson. Nick Leeson did what every rogue trader does. He kept two accounts. One account for his profits and one account for his losses. Obviously, this is illegal. But he was a rogue trader, so he kept two accounts and he hid the second account where he put all his losses in from his superiors. His superiors thought, oh, this is a great trader. He's only reporting profits, profits, profits. So they promoted him to chief derivatives trader in the Singapore office of Barings Bank. And he traded and traded and traded. And this would have gone on and on and on. But at some point, something happened that he didn't expect. The great Hanshin earthquake in, the Hanshin area, that is Kobe and Osaka in Japan. Probably you also do not remember this, but at that time this was a huge disaster. Almost 2,000-3,000 people died in that earthquake, the last major earthquake in Japan that happened on land. There was the earthquake where also freeways fell over, and they had fires and so on. A huge disaster that seriously crippled the Japanese economy and that also led to all Asian financial markets to go down. And at that point, Nick Leeson, the rogue trader at Barings Bank, was no longer able to hide his losses because they were big and huge. What did he do? He packed his suitcase, went to the airport and fled the country. He was arrested at Frankfurt Airport and extradited to the UK, where he was sentenced and went to jail. I think he then suffered from cancer, recovered, and he now, you can watch videos from him now. He speaks on conferences now and tells people what an awful world the financial markets are. But Barings Bank suffered a loss of, I think, 2 or 3 billion pounds, was bankrupt overnight. They had to close down the next day, and there was a fall of Barings Bank. And you can see several things went wrong at Barings Bank. First of all, they had insufficient control mechanisms. Internal processes failed. The internal risk management and internal governance failed because they didn't see that an employee was acting illegally. So internal processes failed, personnel, employee failed, illegal behavior of an employee, and an exogenous event, an external event that brought it all up to light. And this is the prime example of an operational risk. And you have 3 types of operational risks here in play. Internal processes, a rogue trader, and an earthquake that exposed this. Okay, so these are the different types of risk. Now, what can you do about them? First of all, you can measure risks. And in quantitative risk management, everything is based on loss distributions. You do not care about percentage changes in volatility. You do not care about reputation losses. You care about money. You care about financial losses. And that is why, in the end, you will base all your risk measurement on financial loss distributions. Or if you, for example, have this, and these are your losses, and these are your profits. This is what we will refer to as a P&L, or P&L, a profit and loss distribution. If you only care about this here, the losses, then it's a loss distribution. How can you justify this view? First of all, in financial risk management, you only care about financial losses, period. Loss distributions can be grouped. They can be summed up. If you have two positions, if you have two assets, you can sum up the two loss distributions, X plus Y, and you will have the loss distribution of your combined portfolio. You can account for netting and diversification effects when using loss distributions, and you can compare them. If you have two distributions, you can subtract them, you can compare them with each other, and this will allow you to measure your risk. Loss distributions also have a couple of disadvantages. First disadvantage is, as with any statistical distribution, you need data to model your loss distribution. But that's not a disadvantage, that's just a requirement. If you do not have data, well, then how are you supposed to measure your financial risk? In addition, measurement with the help of loss distributions involves a large model risk. What does it mean? If, for example, you probably all know the Gaussian distribution or the normal distribution, Normalverteilung, Gauss-Verteilung in German. I can model your age by using a normal distribution. I would ask each and every one of you for your age, and then I can estimate the mean, I can estimate the variance of your age, and then I would simply say the age is normally distributed with these two parameters, and let's assume the mean is 23.2 and the volatility is, say, 3.89. Then these would be my two parameters. The model would be a normal distribution. I could have also used a t-distribution. I could have used a uniform distribution. It's up to me. And that's why I have model risk. If I choose the wrong model, if I choose the wrong parameters, if I estimate the parameters in an inaccurate way, I have model risk. The model might not fit the data, or it might not be able to fit the true underlying distribution. That's model risk. By the way, also great papers by Jon Danielsson on model risk from LSE. However, yes, we have model risk. Yes, we need data, but that only means that you should do a proper job. If you don't have data and if you don't have a clue about modeling, well, then you shouldn't be the risk manager of a company in the first place. But if you are the risk manager, if you have some expertise, don't care about model risk, yes, care about model risk, but do a proper job and try to generate data and come up with the data that you can use and feed your models. Okay. If we have a loss distribution, what should we do next? You need some key figures, key statistics, moments, or single values of this loss distribution with which you can measure risk. For example, you can use the mean, the expected value. That could be one statistical figure, one statistical number you could use based on a loss distribution. You could also say, I do not use the mean, but I will use the median. Slightly different. I could use the volatility as the square root of the variance. Then I could use the variance, and so on. So we need some risk measures based on loss distributions. We'll talk a lot about this in financial risk management, but some examples are here on the next slide. The expected loss, the variance of the loss, the maximum loss, all of these are not very well suited for risk management. The expected loss can be used and is used in credit risk, but it's a very, very simplistic way of looking at losses. The variance has the disadvantage that it's given in, for example, euros squared. So the variance is not very well suited, and also it equally weights profits and losses. And the maximum loss, well, in the end, we are all dead. Yeah? That's the maximum loss. If I have an investment of 1 million, well, I can lose 1 million. The maximum loss is quite simple to calculate, but it doesn't really help in risk management. I want to know what is likely to happen. I don't want to know what is the worst case scenario. In many financial settings, I know what the worst case is. I can go bankrupt and I can drive my car against a wall. Okay, finito. So this is not the best way to do a measurement, but what we can do is we can use the so-called value at risk, and later on we can use the so-called expected value. Those are the two most important risk measures that can be found in banks and insurance companies, and also in large industrial firms. And we'll talk about these next week. Do you have any questions? Okay, so if you have no questions, then I'm done for today, and thank you for your attention, and see you next week. Thank you.